Welcome to the third of our presentations that extract sections from our Insight presentation in February, entitled We've Been Here Before. This is the third part and is entitled The Folly of Trying to Time Markets. And we're going to look at just maybe some of the hazards around trying to time the market. I do want to recap by going to this slide, which is broken down into two parts. The left-hand slide illustrates the top 40 shares on the JSE by size, what their price change was during the 2018 calendar year. So you can see by far the vast majority of shares had declines, many of them more than 20% and on occasions more than 40%. Very, very few shares actually saw upside movements. And I think that pretty much caps people's understandings and feelings about markets last year. The right-hand chart is the same companies but charted slightly differently, also for the 2018 calendar year. But what we're charting here is the change of the dividend compared to the prior year. So you can see again, most of the shares actually increased their dividend compared to the prior year, and there were a number of shares that declined their dividend but or reduced their dividend, but they were very much the minority, and that really speaks to the Harvard House philosophy of chasing dividend as opposed to share price change. You'll recall that we chose to use Standard Bank as the example. This chart we went through in the second of this presentations. The red block assumes a 20,000 Rand investment back in 1998 and suggests that by the end of 2018, inflation adjusted, your money should be worth just north of 55,000 Rand. The light blue trace is a shareholding in Standard Bank, and it assumes, as we will see shortly, that big decline in Standard Bank in 1998, which was nearly 68%. And you can see that if you had held the Standard Bank, used the dividends for whatever you might have, you would have still handsomely beaten inflation. And then the dark blue trace follows a Standard Bank holding, also bought at exactly the same time, suffering the same initial loss. The only difference here is that going into the future, every time a dividend was declared by Standard Bank, you bought extra Standard Bank shares on that day. And there you can see the value well ahead of 255,000 as at the end of 2018, which is more than four and a half, getting close to 5 times what inflation would be over the same period. So demonstrating, as we did in the last presentation, that holding through difficult times in good companies is the right thing to do. But let's revisit the common question: shouldn't I rather move into cash? The markets are so volatile, they've been all over the place. Cash gives me a certain yield, and I've got no risk on my capital. So let's assume my 20,000, and very seldom you would time the top. It is amazing how many times people time the bottom in selling out. But let's assume you did time the top, which is unlikely, but you bought Standard Bank, your 20,000 Rands worth of Standard Bank, at 32 Rand 90 a share on the 22nd of April 1998. Now, we've already visited the fact that by October 98, the share would be trading at 10 Rand 40, which is 68% down. But let's assume this idea of shouldn't I rather move to cash? I don't like the volatility. So let's assume on the 17th of August 1998, Standard Bank is now trading at 20 Rand a share. You've lost 12 Rand 90 a share. And you take the decision that I'm going to get out of the share. I think it's going down, which, as you can see, you were proved right in that assumption. But I'm getting out and I'm going to sit in cash and I'll come back at a better time. So you can see at 20 Rand a share, your 20,000 would realize 12,158 Rand. which you then put into cash. So now what I'm going to do is I'm going to compare two cash flows, and the green cash flow assumes I bought the Standard Bank with my 20,000 and I held it all the way through and I collected the dividend. Now the green is the dividend in rand value every year from 1998 through to 2018, and you can see there is this nice appreciation over time. And there were a few difficult times for Standard Bank. You can see 2005, 2006 decline in the dividend, 2008, 9, 10 and 11 where the dividend declined and went flat over the period. But overall, a healthy increase in the dividend over time, certainly well ahead of inflation. The red block by alternative, or the red bars, illustrate the interest I would earn on my 12,178. So certainly many an investor who sold out halfway down would be feeling very smug. I made the right choice. I got into cash. I'm getting good interest. But as you can see, by 2004, 2005, with interest rates having coming down, markets having recovered, the dividend from Standard Bank way exceeds the cash payable on the interest rate, my fixed deposit. And by 2018, you can see I'm getting less than 1,000 in interest, but my dividend is moving fast towards the 6,000 rand mark, which is almost 25% of what I paid for the shares in the first place, in spite of experiencing that rather horrible decline right after purchasing. So what I've done here is I've said, okay, let's assume that I'm now going to do what I said right in the very beginning, was I'm going to move to cash, and then at a later time I'm going to move back into Standard Bank, and then I will collect my dividend going forward when things look a little bit better. So the share price only really got back to where it was around about the end of 2002. So let's assume in 2003 I took my cash plus my accumulated interest, and I now bought back into Standard Bank, and I've collected my dividend in that year. And the dividends from this new shareholding in Standard Bank is the blue blocks, and you can see that I am appreciably behind the green, the guy who held the shares all the way through, because I realized my loss, and I have now bought less in the way of Standard Bank shares. And although I still enjoy better than cash going into the future, I never really appreciate or get close to the guy who held all the way through with the green block. Let's have a look at that in terms of share price. I'm only going from 2004 here. Obviously, it doesn't make sense to go back from 1998 because it's only at the end of 2003 that I really buy my shares back into Standard Bank. But the dark blue is the value of the holding of the guy who had bought the original 20,000 rands worth right at the peak in 1998. He had 607.9 shares. And you can see his value continues to be volatile. Even 2008-9, we get the financial crisis. 15-16, as we've spoken about, was when Nene was fired. And then earlier part of this year, when there was some volatility in the American markets that fed through. The light blue line is what I've bought from my proceeds of my fixed deposit, rolling my fixed deposit over the time where things got better. So now I'm only getting 310.31 shares. And the interesting thing that you will notice is that as I go across, in the early part of 2019, after the end of 2018, my value is less than inflation over the full period. So by having jumped out, realized the loss, and moved through the period, I'm actually suffering a less than inflation return over the long term, even though I got in and enjoyed some pretty good times in Standard Bank over the last 14 years. So in summary, we know that there will always be failures in the market. There are also going to be bouts of volatility and uncertainty, and possibly that's even more the case these days with computers trading, what we call algorithm trading. There is always the temptation to time the market. And that's largely because in hindsight it's obvious, and also we want to make a flight to certainty. Volatility or share price depreciation makes us feel unsettled and fearful. So we always think rather, go somewhere safe and come back when it's better. And, the third thing is that the risk of poor timing is not easily demonstrated. And even more so, I would say that very few people would admit to having made mistakes, because we're probably not great at doing that as human beings. A good quality company can and often does recover. Now, obviously, there'll be companies that don't and may take years and years and years to recover. And that's where good asset management ultimately comes in. And we believe the fundamental base of Harvard House philosophy that a dividend-led income is the only secure method to provide long-term peace of mind. And that is why we build our portfolios the way we do. So thank you for tuning in. Please feel free to visit our website for more information, and we will continue to do these series into the future. Thank you for your time.